46 billion yuan, first half of 2026. That's how much capital flowed into China's embodied intelligence and robotics sector in 6 months. Not just humanoid robots, the full spectrum, robot pets, quadrupeds, embodied AI models, the funding covers all of it. 140 companies, thousands of units rolling off lines. New factories announced every week. Unitree just IPO'd on the stock market, one of the fastest registrations in the exchange's history. The industry is scaling fast. Everyone is racing to build more. Nobody is racing to find out what to build it for. This episode isn't about whether humanoid robots will succeed. They probably will, eventually. This is about what happens to the companies scaling before success arrives. Because history is very clear on this point. The companies that scale first and the companies that survive to capture value are usually not the same. Let's start with a number everyone celebrates. Unitree. Revenue from RMB 159 million to RMB 1.699 billion in 2 years. CAGR 227%. Profitable in 2025. RMB 278 million net income. The first humanoid robot company to turn a profit in China's public markets. Impressive, until you look at where the money comes from. 73.6% of Unitree's humanoid robot revenue comes from universities and research institutions, not factories, not warehouses, labs and classrooms. The industrial use case? 9%. And of that 9%, true industrial manufacturing revenue is roughly RMB 15.7 million. The rest is lobby reception, greeting visitors in corporate showrooms. The company that proved humanoids can be profitable did it by selling research tools, not productivity tools. This isn't a criticism of Unitree. They found a working business model in a market where nobody else has, but calling it industrial adoption stretches the definition. A robot in a university lab demonstrates capability. It doesn't prove economics. Now look at the ROI for actual deployment at today's economics. A single humanoid robot costs roughly RMB 500,000 to purchase. Annual maintenance runs RMB 100,000 to 150,000. Operating efficiency, 30 to 60% of a skilled worker. Payback period, 5 to 8 years. The industry baseline for industrial equipment is 3 years. Every deployment you read about right now is strategic positioning, not commercial viability. Companies place robots in factories to demonstrate capability, to show investors, to show partners, not because the math works. If demand is unproven, what happens to all the units coming off the line? Agibot produced roughly 5,000 units in Q1 2026. Industry research estimates suggest 30 to 40% went straight to inventory. Hundreds of millions of yuan in capital sitting in warehouses. Of the RMB 46 billion in total sector funding, over 40% has been consumed by inventory buildup, exhibition showcases, and team expansion. Not R&D breakthroughs, not proven deployments, stockpiling and showmanship. Then there's UBTECH, the company everyone points to as the industrial use champion. 2025 sold 1,079 humanoid robots, revenue of RMB 820 million, up 2,203%. The headline number is staggering, but losses? Net loss attributable to parent, RMB 703 million. Revenue scaled, losses scaled with it. That's the sentence that should trouble anyone looking at this industry. UBTECH didn't lose money despite selling more units. They lost more money because they sold more units. The unit economics don't work. Every additional robot shipped deepens the hole. The math is uncomfortable. The 140 companies in this space? Industry insiders expect 80 to 90% will fail. The CEO of Xinhaitu predicted industry consolidation within 6 to 12 months. This is the classic shakeout pattern. Too many entrants, too little differentiation. Everyone is building roughly the same product with roughly the same components. The only variable most companies are competing on is production volume. But volume without margin is just a faster way to lose money. And this isn't a China-specific problem. Tesla Optimus operates in pilots of 1 to 5 units per site. Figure AI, valued at $39 billion, has shipped roughly 150 units. The demand question is global. Nobody has found a product market fit yet. That's the current state, not the end state, but the current state. The uncomfortable truth is that 2026 might simply be too early. Not wrong, just early. The technology is impressive. The engineering is real. But between a working prototype and a viable product, there's a gap that no amount of production volume can close. Volume solves supply problems. It doesn't create demand. So here's the question nobody asks. If demand is unproven, if ROI doesn't work, if inventory is piling up, why is everyone still scaling? Because in heavy asset industries, not scaling is more dangerous than scaling without demand. Here's the logic. It's not irrational. It's survival. Scale generates revenue. Even if your units go to inventory or demo sites, the production numbers look good. Revenue is up, capacity is expanding. The story writes itself. Revenue enables financing. Growing top-line numbers let you raise the next round. Government guidance funds, venture capital, strategic investors. They all want growth. Scale gives them growth. A company producing 5,000 units per quarter raises more easily than one producing 500, regardless of where those units end up. Financing funds survival. The industry hasn't found PMF yet. Everyone knows this, but you need to stay alive until it arrives. Staying alive requires capital. Capital requires a story. The story requires scale. So you scale, not because customers are demanding more units, because investors are demanding more growth. The cycle. Scale revenue financing survival scale again. Each turn through this loop, one thing hardens. Debt. In heavy asset industries, scaling means factories, production lines, tooling, supply chain commitments. These are not easy to unwind. A software company can pivot in a quarter. A factory cannot. Every expansion adds fixed costs. Those costs must be serviced, whether demand exists or not. The bet is simple. Can you survive until PMF arrives? If yes, your scale becomes an asset. Your factories are ready. Your supply chain is established. You capture the market. If no, the debt you accumulated while waiting eats the company. This isn't hypothetical. It's a pattern. And it plays out the same way every time. The Chinese steel industry went through the exact same cycle. Scale big, profit big. That was the operating belief. Tiban Steel, Taishan Steel, DeLong Nickel, companies that expanded aggressively. Build capacity on the assumption that size itself would generate returns. It didn't. Many didn't survive the down cycle. The ones that did carried debt structures that took years to restructure. I know this firsthand. I spent years inside a Fortune 500 steel company. I watched the cycle play out from the inside. The logic always sounds the same. Build capacity, capture share, wait for demand. The problem is, when demand doesn't show up on schedule, the debt doesn't wait. Solar was worse. Huadong Zhongji redirected RMB 8 billion into solar manufacturing. Gross margin, negative 15.75%. Every unit sold at a loss. Financed by debt that assumed demand would eventually catch up. It didn't. The company entered bankruptcy restructuring with RMB 11.3 billion in debt. The solar industry built more capacity than the world could absorb. For years, prices collapsed, margins went negative. Companies survived on government support and new financing rounds. Sound familiar? Steel, solar, humanoid robots. Different products, different decades, same structure. Scale before demand. Finance before profit. Debt before survival. There's one more layer. Even if the technology works and the factories are built, the social gate hasn't opened. 3 days before I wrote this script, July 13 to 15 Hyundai workers at the Ulsan plant went on strike. The first labor action anywhere in the world specifically targeting humanoid robot deployment. Not a single robot without labor management agreement. Daily production loss, $134 million. This isn't new. Elevator operators resisted automation for 50 years. Dock workers struck in 2024 over port automation. In 1959, 500,000 American steel workers walked out. Technology being ready and the workplace being ready are not the same thing. They never have been. MIT's Asimoglu and Johnson made this explicit in 2023. Technology's benefits require the right conditions to be shared. The Engels pause output rises while wages stagnate for decades is the historical norm, not the exception. Societies don't adopt technology on the technology's timeline. They adopt it on their own. So the humanoid robot industry faces a triple gate. PMF not proven, ROI not proven, social acceptance not proven, and companies are scaling as if none of these gates exist. There is a boundary to the scale trap. It applies to heavy asset industries, where scaling means physical infrastructure, fixed costs, slow pivots. Software and technology services don't face this trap the same way. Marginal cost approaches zero. You can experiment cheaply. You can fail and try again without debt crushing you. But for anything that requires a factory, the scale trap is real. And it's rational. That's what makes it dangerous. Everyone involved is making logical decisions. The founders, the investors, the government funds. Each individual choice makes sense. The collective outcome is a trap. This is what heavy asset cycles look like from the inside. Nobody sets out to build a debt spiral. It builds itself, one rational decision at a time. In 1856, Henry Bessemer patented the process that made steel cheap. He made roughly $150 million from his invention. Adjusted for context, a fortune. Andrew Carnegie didn't invent anything. He used Bessemer's process and others' inventions to build an integrated production system. Vertical integration, cost discipline, scale with purpose. Carnegie's fortune, $18 billion. Bessemer's invention, Carnegie's industry. The Wright brothers invented the airplane, sold the company in 1915. Boeing was founded in 1916, didn't invent anything. Caught the military to civilian conversion after World War II, became the dominant aircraft manufacturer for half a century. The inventor validates the technology. The builder captures the value. But the builder shows up after demand is proven. Carnegie built his empire after railroads needed steel at scale. Boeing became Boeing after the world needed aircraft at scale. The demand came first. Then the scale. Not the other way around. This is the part that gets missed in every hype cycle. The technology pioneers and the value capturers are rarely the same company. The pioneers burn capital to prove something works. The capturers arrive when the economics are clear. They build with discipline. Not with urgency. China's humanoid robot industry has its Bessemers. Companies racing to prove the technology, scaling production, burning capital. What it doesn't have yet is its Carnegie. The company that will capture the industry when demand actually materializes.
That company may not exist yet, or it may be one of the 140, waiting, preserving capital, watching others burn cash to validate the technology. Either way, whoever captures this industry won't be the one that scaled fastest. It will be the one still standing when demand arrives. Scale buys time, debt collects it. Next episode, we leave the factory floor. China's pharmaceutical industry spent 5 years in the valley. Valuations crashed. Exits frozen. Now something is turning. A drug candidate just got breakthrough. Therapy dissemination capital is flowing back in. But the question is the same one we keep asking. Who captures the value? The company that invents the molecule or the one that sits in the right position in the value chain? See you then.